Most Singapore households are expected to cope with more expensive mortgages, but the country's central bank has warned that borrowers with more debt could be at risk. And that's because domestic interest rates have gone up in tandem with global rates amid higher inflation. Heidi Ng with more.
Mr. Fu Xuan Kai was looking forward to upgrading to a larger home with the arrival of another child, but his family is shelving those plans for now and watching their spending more carefully.
Does it seem like if I'm buying a property now, it would be at a wrong time, given that the prices are so high? And at the same time, I have lesser incentive to upgrade to a bigger home, knowing that I'm going to pay a lot for interest on a monthly basis.
Their monthly mortgage repayments was about $2,800 in January. Now it's $3,900, an increase of about 30%. The Monetary Authority of Singapore says households are more vulnerable to income and interest rate shocks. That's because a greater number of homeowners took on more property loans. With the economy recovering, people are also spending more. But the central bank says most households can still pay for their expenditures and service their loans. That's because unemployment rate is low and wages continue to grow. That's even under a scenario of a simultaneous 4 percentage point increase in interest rates and a 10% reduction in income. MES adds that the proportion of non-performing mortgage loans is likely to remain low.
Singapore has very stringent debt-to-income requirements. Okay, so the amount of debt Singaporean consumers can take is relatively low to their income, which means there is a lot of buffer, okay, for Singaporeans to absorb higher debt service payments before they can become illiquid and they have no money. The second thing is Singapore has very stringent loan-to-value requirements. So not only liquidity, but vulnerability of default is very low.
The MES cautioned vulnerable households like lower-income families and those with higher expenditures. These segments of the population need to be cautious about taking on more debt in the current climate.
If growth is slowing down, labour market will surely soften. When labour market softened, wage growth will be impacted. When job vacancy starts to decline, that is a first telltale sign that the labour market is softening. And then, if growth momentum really slow down significantly, if we head into a technical recession, and some companies may have to lay off some headcounts. So we need to be mindful about that, that we are entering a soft patch in 2023. So Singaporeans need to be mindful about their debt level.
MES adds that households should exercise prudence in spending and taking on debt to cushion against tightening financial conditions ahead.